Alibaba, China's Amazon. Named after Alibaba from 1001 Nights, it is one of the most controversial, but at the same time, most exciting stocks right now. So, what does Alibaba do? Well, first and foremost, they are an online commerce platform. They sell retail, they sell wholesale, they sell single items, they sell container loads of items. This also includes a logistics platform and global fulfillment network, Sinow network, and an on-demand delivery and services platform, LME. Then they also have a rapidly expanding cloud business in addition to some small entertainment, gaming and other business units. But in this video, I'll mainly focus on the online commerce and the cloud business, as they're pretty much the two pillars of Alibaba's business strategy. So let's look at the online commerce. Is it doing well? Well, it's doing fantastic. The last year, it grew by 35% year on year, and over the last 5 years, online commerce sales have increased by almost 500% from 92 billion renminbi in 2016 to 436 billion in 2020. And to give you a better idea, $1 was roughly 7.08 renminbi back then. So Alibaba's online commerce revenue in 2020 was roughly 61.5 billion US dollars. So revenue, obviously, it's extremely important for business growth. So seeing a 35% increase is quite amazing. In fact, this is almost unheard of for businesses of this size, which just shows you how unique Alibaba really is. And then the earnings from online commerce also grew by roughly 22% to 165 billion renminbi, or 23.4 billion US dollars. So how are they doing that well? Simple. They did get the boost in online sales because of the pandemic, but they also have 780 million active consumers on their online marketplace in China and another 180 million internationally as of the end of 2020. They also have 846 million mobile monthly active users. Essentially, they've got more consumers than the population of the US and the EU combined. And that's just one company. It's crazy. But it gets even better though. See, Alibaba's online marketplaces include several websites, but not just any websites. In fact, the company owns two of the most visited websites in the world. In the world. Tmall and Taobao. Alipay also ranks in 26th place in terms of most visited websites, and AliExpress ranks in 42nd place. I mean, the company's presence is just mind-boggling. And to top it all off, the business model is much lighter than Amazon's, for example. Why? Well, Alibaba doesn't sell its own products. It doesn't have any inventory, it doesn't have any warehouses, which results in less expenses and a higher net profit. How much higher? Well, Amazon's latest net profit margin was 5.53%. Alibaba's? It was 24.71%, almost 5 times as big. So, the online commerce is the main driver behind Alibaba's amazing performance, as currently none of the other business segments are producing any meaningful earnings. In fact, the digital media and entertainment and the innovation incentives and other segments are actually losing money. Although the CEO has explained that their purpose is not to be profitable, but rather to augment the Alibaba brand and support the online commerce platform. Now, cloud computing? That's a bit different. In the fourth quarter of 2020, it finally broke even. It's an important part of Alibaba's long-term strategy, and they're placing a lot of emphasis on growing it. In 2020, cloud revenues grew by almost 62%. Alibaba Cloud is currently the biggest cloud provider in China, and they intend to stay that way. Overall, the company is growing fast, roughly 38% increase in sales year on year, with net income rising roughly 70% in the last year. We can see that the core business and the future business of Alibaba are doing well, but how are its financials though? Well, it has a lot of cash, roughly 330 billion renminbi, and its current assets are enough to cover all of its liabilities, so they're looking very healthy. In fact, they've also got enough free cash to start repurchasing shares. In the final quarter of 2020, they repurchased roughly 110 million US dollars worth of shares, which is not that much honestly, but they've approved a share repurchase plan of between 6 and 10 billion US dollars. And if we see the maximum on that plan, investors could get very, very, very excited. So the business is growing fast, the financials look solid, they're starting to return money to the shareholders. What about the price though? Well, the company is relatively cheap right now. Their PE ratio is 25.5 with a forward PE ratio of 20.6, and historically they have a PE average of roughly 34.5, so we can see that they're on a really big discount right now. Their price to book ratio is 5, which is normal for them, so there's that. Compared to their direct Chinese competitors, Alibaba's PE isn't actually that low, but I would say that the reason behind it is that most of its rivals are only involved in online commerce, whereas Alibaba is also the leader in the rapidly growing cloud computing business. Also, if we compare Alibaba to Amazon, which is pretty much the closest comparison that we can get in terms of business segments, we can see that Amazon's PE has not dropped below 60 in the last 5 years, and their PE average is 137, which is way higher than Alibaba's. Amazon's price to book ratio is also roughly 18, or almost 2.5 times higher than Alibaba's. Their revenues and earnings are growing at roughly the same pace, although, to be fair, Amazon did have a phenomenal year in 2020. But Alibaba has also beaten the last 10 analyst earnings estimates and the last 8 revenue estimates, so they tend to outperform, but that's still not baked into the price. Still, I think that their next quarterly earnings will probably be a miss due to the fine that was imposed on them, but we'll see how that goes. And essentially, looking at the price, I'm just thinking that investors have simply not priced in the growth in the share price, which essentially means that Alibaba is a great deal, at least in my opinion. And also, most of their competitors are focused only on online commerce, which means that Alibaba has a better overall offering and competitive advantage than them. It's got better sales, better net profit margin, better brand presence, better long-term strategy, and more users than Pinduoduo, Vipshop, and JD. It's no wonder that virtually all of the analyst recommendations for this stock are either buy or strong buy. Clearly, it's the best deal, at least in my opinion, but in all fairness, even its competitors are doing really well. And some people who agree with me on Alibaba are Ray Dalio, whose third biggest stock holding is Alibaba, and Charlie Munger, who just bought into it with 20% of his daily journal portfolio. Now, Alibaba just looks too good to be true, right? Sort of. Alibaba does have some issues, but they're of slightly different nature. The main risks involved with the company are more political. First of all, you have the SEC threatening to delist any companies that are doing business with the Chinese military, that don't provide proper financial statements and reporting, that have a Chinese Communist Party member on their board, or are controlled by an entity of a foreign government. Now, technically speaking, just because a company gets listed doesn't mean that you cannot trade it, but chances are that its stock price will be hurt. A lot. You'll still be able to trade it over the counter, but that brings a lot of problems of its own. So chances are that most online brokers won't support it. I know that my broker, eToro, does not. Still, you can easily avoid that by simply buying Alibaba stock that is trading on the Hong Kong exchange. The ticker is 9988, but it's essentially the same stock. Personally, I don't think that they will delist Alibaba, but don't take my word for it. Buying the Hong Kong stock will ensure that you're protected from that threat, really. Currently, there is also an ongoing regulation crackdown in China aimed at the big tech companies, and Alibaba was famously targeted because its founder, Jack Ma, criticized the Chinese government's approach to financial regulations. As a result, the IPO for Ant Group, which is essentially Alibaba's spin-off that deals with consumer financing and lending, was squashed late last year, and restructuring was ordered. More recently, more regulation and more restructuring was ordered. While this has affected Alibaba's business model to an extent, the regulations have also affected Alibaba's direct competitors, so the company still retains its competitive advantage. Furthermore, the regulators also handed Alibaba a fine of 2.8 billion US dollars, the biggest one ever handed so far. They also ordered the company to stop its anti-competitive practices, which involved Alibaba making merchants choose between using only Alibaba or rival platforms. So, the big question is, are the regulators finished with Alibaba? And to be fair, we can only speculate on that. The biggest worry that investors have right now is that the regulators will break up Alibaba into different smaller businesses, which is a possibility, although a lot of analysts say that China will not risk destroying one of its biggest and most famous companies. They do seem to have moved on to other tech companies, but as I said, this is not something that we can know for certain. So, what's the verdict? Is Alibaba a good investment right now? Personally, I think so. It is undoubtedly risky, but the company offers such amazing prospects that it's just crazy to miss out on. I mean, if you could buy Amazon at such a cheap price, wouldn't you? I'll recommend doing your own research into it, but I believe that it offers a great opportunity right now, and that's why it's my second largest holding and almost 10% of my total portfolio. And in case you weren't aware, Alibaba will be reporting its earnings next Thursday, so check them out to see what could happen. There will probably be a lot of price action before that and likely after it, hopefully in a nice positive green upward trajectory, but we'll see that next week. Alright, so these are my 10 cents on Alibaba. Let me know what you think in the comments below. If you think you've learned something from this, like, subscribe, share it with your friends. Thanks for watching, and I'll see you in the next video.